Hello and welcome back to the channel. This is a short video that will explain some of the questions I've gotten the last couple of days, where people have wondered why it can be that Tesla comes out with an earnings report that is a lot less than expected, and they go up in price, and Meta comes out yesterday with a fantastic earnings report and the stock drops. Well, in this video, I will use my stock scanner to try and explain how that can be. First of all, we have Tesla. And if you know Tesla, maybe you own Tesla stocks, you know here, this is on a weekly and a daily chart, you can see that the stock have plummeted in price, gone down by something like, I think it's 60% over the last couple of years. And that is a part of the explanation why the stock went up yesterday by something like, I think it was 12%. Yes, here went down, and then the earnings report came out and the stock skyrocketed just up to that resistance area I have put on my chart here. Now let's have a look at Tesla. If you have seen my videos, you know that I have three questions that I ask myself when I am about to invest in a company. Is it a solid company? Is it well priced? And is now the time to buy? Now, if we look at the Tesla stock, it is actually not a terrible stock. It's not a terrible company. Some of you think I'm just a Tesla hater because I am hitting on Tesla once in a while, but it's actually more Elon Musk that I oppose, but I will get back to that later. Because if we look at it, the quality of the company is actually quite decent. If we look at, well, the earnings per share growth in this year is expected to be negative, meaning we can't get a PEG ratio. If we go down here, it has a fairly low Petrusky score, doesn't mean that much. Altman C-score is great, so it's a safe company. Analysts are a bit split here, and a lot of the analysts have downgraded their expectations for the future results here over the last month, so that is not that good. If we go down here, we can see that, well, earnings per share growth is expected to drop here and then rise again in 25. We can see that the return on capital employed is actually not that bad. I normally take at least 12 when I'm looking at a stock, and this has this 12-13-ish here, so that is not bad at all, and in 22 it was 24.5%. Going further down, we can see that they are struggling a bit with their cash flow, definitely, but they have a fantastic interest coverage and they have a lot of working capital and cash. So all in all, it's not like I'm running away screaming from the stock. It's not one of the most solid stocks I have ever seen, but it is absolutely not a bad stock. They are making money. Now, the thing is that when we get to the valuation chart here, you can see that we have some analysts. And the analysts are expecting a drop in the earnings per share growth in 24 and a rise, as we saw in the summary page in 25, around 35%. Now, the analysts are expecting a price over the next 2 years to go up by 5.7%, meaning from the current state and up to around 171 here. If that is correct, then they will end with a price multiple, a PE, of around 50. Now, I was out in both 22 and 23 and saying that I saw the price earning of the company of 60, 80, 100, at a point 150 to be absolutely ridiculous. We are talking about a company that are very good at producing EVs. However, what they are priced off is that Elon Musk and a lot of his followers have talked about solar panels, spaceships, Mars settlements, supercomputers, fantastic batteries, semi-trucks, cyber-trucks, roasters, Tesla 2 that will be cheap and all that stuff. And there are entire websites with all of Elon Musk's promises and the number of days that have passed since they should have come true. For instance, for 10 years ago, he promised us full self-driving cars, which drove the stock price up. And in 2022, he promised way back that Tesla would have between 500,000 and 1 million self-driving robo-taxis driving around the world, basically taking over the entire taxi market. Now, the reason why I'm mentioning that is that is the reason why Tesla have been able to have PEs of 270 in average over the last 5 years. Completely ridiculous. Now, are they going to have a PE of 50 in 2 years' time? I doubt it. Last year, I predicted we should down between 25 and 35. Right now, we are around 40. Other car companies, and yes, I am putting Tesla in the same category as other car companies, they have PEs around 10. But let's just say that there's still some hype around Tesla stocks and that they can have a PE of 30. That means that if these estimates are correct and the PE should go down to 30, well, then they would have a negative minus 37% over the next couple of years. Now, why did Tesla then go up? Why did it go up 12%? Well, there are several reasons. First of all, one of the reasons Tesla have been dropping so quickly here is that a lot of short investors have been shorting the stock. There's nothing wrong with shorting a stock, and the thing is that the second you need to get out of your position, you need to buy back the stock, meaning it hasn't really had that big of an effect in the stock market. First you sell the stock short, and then you buy it so you can deliver it back to the ones you borrowed it from. So a lot of the shorters had to cover their positions, or they chose to cover their positions, because in the earnings report, Elon Musk said that at the end of 2025, they were aiming at having some sort of a cheaper Tesla out on the street. Someone then asked in the earnings call, said, well, are you talking about that $25,000 car here, Elon? And he just brushed it a bit off and said, nah, well, we have talked about that. Let's move on. And that means we don't really know what he meant by that. Maybe just that he will be cutting prices on some of his other cars so that the margins will keep going down. Anyway, that meant the stock went up. And one of the reasons, of course, is that up here, Tesla was priced for perfection, meaning that nothing could go wrong. The same here. Everything had to go right for the stock to keep going up. And it wasn't going right for Tesla and for Elon Musk. A lot of things have gone wrong for them. And I'm not saying this to be a Tesla hater, because I actually admire how Tesla have been able to make EVs kind of a sexy thing. It's okay to drive. It's fantastic to drive an EV now. It wasn't that hot 10 years ago. So hats off for that. However, I'm not a big fan of a CEO that is pumping the stocks. But the stock had plummeted, and that is one of the reasons why I could get that big juicy gap up here. I'm not sure it's going to last, but let's see. Now going to Meta, and they came out with an earnings report yesterday in the aftermarket, and looking at the stocks in the pre-market or aftermarket here, we can see that they are set to open something like, how many percent? 13, 14% below the closing price yesterday. So that is, of course, a massive cut. Now, why can that be? Well, one of the explanations you are seeing here. Because when we're looking at Meta, it has gone up. When it was at its top, it was up almost 500% in 1.5 years. So let's go in here and have a look at Meta. They are fantastic quality. They are really, really one of the best companies. They have a PEG ratio of only 0.5 with an expected earnings per share growth of 26% next year. Absolutely outstanding. Great Petrosky score, outstanding Altman C score. Analysts love them. Upgrades with the many analysts here. Looking at return on capital employed, double the amount of Tesla here. Fantastic free cash flow, huge interest coverage, great working capital and cash here. So our first question, is it a solid company? Yes, it is. And they are making a ton of money. Now then, why is it dropping 13, 14%? Well, that has to do with the fact that earnings per share in the last 1.5, 2 years have gone up by something like from the end of 2022 until now has gone up by something like maybe 100, maybe 120%. But the stock has gone up almost 500%. So the stock price have way outrun the growth in earnings per share. So let's try and look at that in a value chart. We are looking 2 years ahead here. And we are using the analyst estimates here. They are saying that Meta will grow a lot, and they're saying that Meta will have a P around 23. Now, is that a respectable number? Well, we can see they are currently around 33. We can see the 3-year average is around 21, 5-year average 24. So that actually seems like a fairly decent number. Now, if that is correct, if that number is correct, just remove that one, then Meta will have an upside potential of around 1.3% in 2 years. And if we are putting on the 5-year risk-free interest, we can see that we'll actually gain quite a lot more money of just putting the money in a bank account or a secure bond. So what happened with Meta is that one is priced for perfection. It hasn't had the big drop yet. And when the stock is priced for perfection, doesn't mean it can't go up, because of course it can. It just needs a bit more hype among investors, and it needs to say all the right things, throw in some AI in their earnings report and in their earnings call. But they can't say much wrong. And in the earnings call yesterday, Meta said that the revenue the next 1 or 2 quarters might not be just as good as investors and analysts expected, and that they were going to put a lot of money into some developing of new products that wouldn't show up on the bottom line for the next some years. Investors didn't like that, and that is the reason why they're sending it down. Meta is a fantastic and solid company, but the pricing is not necessarily right. And that is where, if you ask me, many investors are making a big mistake, because they are saying, all right, we have a fantastic company, so it must be a good investment. But if the price have run 100% too fast up and the earnings has to catch up, then one of two things can happen, or actually both can happen. The earnings has to go up, or the price have to drop, or at least go sideways, so that the earnings can catch up. So either prices has to move downwards while earnings are going sideways or slightly up, or earnings has to go up while the price is going sideways or slightly down. That is the reason why Meta dropped, and it's also the reason why Tesla skyrocketed yesterday. Now, I am not predicting what will happen in the future from here, because I have absolutely no idea. I can tell you that I think Meta is a lot more of a solid company. That doesn't mean that it will be the better investment, because it has run up quite a lot, and there might be 10 or 20% more downturn in Meta before the big investors think that it's actually priced correctly. So, should you buy or sell any of them? I have absolutely no clue, and you have to make up for yourself. This is just an explanation, or at least one of the explanations, why Meta went down on a good earnings report and Tesla went up on a less good earnings report. I hope it made sense. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye.